Welcome to the Travelex Weekly Outlook for February 7th. The dollar is off to a good start to the new week. The dollar right now is actually near a 2-week high against the euro. It's also near 1-week highs against a basket of 6 major currencies. The dollar's latest uptrend or improvement in tone stems from some key events that took place last week. The dollar had fallen in the early part of last week. It actually fell to 3-month lows against the euro, also against a currency basket that had come amid expectations that the Federal Reserve might lag some of its major counterparts in Europe in tightening policy. But from about Thursday on, we did see the dollar stage a nice sharp rebound. We did see the dollar firm off those multi-month lows. That came after the ECB, in a surprise shift in tone, really toned down its recent hawkish rhetoric with respect to its outlook for inflation and interest rates. So as a result, we have seen, as of last week, we did see investors really have tempered expectations for an ECB rate hike this year. And so as a result, that basically helped to take the steam out of the euro's New Year rally. We had seen the single currency rise quite markedly from 4-month lows in early January. It was up, I'd say, about 8% from those earlier 4-month lows. But again, the ECB shift in tone to a more dovish sounding stance with regard to inflation, that caused many investors to really scale back some of their earlier bets on a rate hike out of the Eurozone, so that it did put broad pressure on the single currency. Also last week, or late last week on Friday, we did see the dollar get a nice boost from the jobs reports. We did see that the U.S. unemployment rate unexpectedly fell. It got down to 9% for January. That was actually its lowest level since April of 2009. There was another survey that showed the U.S. economy added only a fraction of the number of jobs that investors had expected for last month. I think, but overall, some of the poor weather that we had seen in January, that was largely the result of that. So I think investors really shrugged off the more discouraging non-farm payrolls reports. But given some of the recent positive indicators that we have seen out of the U.S., I think investors really think that the U.S. economy is starting to pick up some strength. And if that is the case, that could reduce the odds that the Fed will have to expand its bond buying purchases beyond June. That is its slated expiration time. So that is a broadly supportive scenario to the U.S. currency. Following a steady flow of U.S. data that we have seen in recent weeks, basically slows to somewhat of a trickle this week. We only have a couple indicators due out. Those are going to be Friday numbers on the U.S. trade deficit, also on consumer sentiment. Then on Thursday, of course, we'll get to weekly jobless claims. And then between now and then, we'll listen to a couple of Fed speakers, including Fed Chairman Ben Bernanke. He is due to talk on Wednesday, see if that can shed any more outlook on the, or shed any more light on the outlook for U.S. monetary policy. That's what investors will focus on this week. But that'll do it for this episode. For the latest on the dollar, feel free to check us out online.